Hey everyone, Bryan Stahl here, the teacher, the student, the entrepreneur, and today's episode, we're going to talk about value-based branding. What is that? I don't care what business you're in, this applies to you. So, what's the world coming to today and how people are doing business? A lot of it is online. A lot of people are searching for whether they need an electrician, whether they need a mortgage person, a realtor. They're looking online and they're starting the process. Here's the feedback that I get from a lot of people that are bringing in business online. They say, oh, it doesn't work. Such a small percentage of people even respond to me. They give up, they quit. And the truth is because they don't know what they're doing. They'll say it's bad leads. There is no such thing as a bad lead. What there is true is that you do not work it properly. So let me kind of give you an example of value-based branding. In my business, in a few minutes, we're going to cut into some examples of what I call value-based branding. But what do you expect a consumer to do? Let's say I get a list of 100 names of people that may have interest in buying a house and need financing. Why should they choose me? What do they know about me? What have I given them? You know what most people do when they're doing direct responses or text messages or emails? They're saying, when would you like to set up a time to talk? I called you 3 or 4 times before, I haven't heard from you back. Can I help you out? Did you give them any type of value? Did you show them that you're any type of authority in the business? Have you done anything to earn their business? No, you've done nothing. What you've done is you were impatient, you gave them zero service and zero value. Here's how you do it. First, your first response is you need to give them some sort of resume. You need to give them some sort of testimonial of someone that has experienced your business. Your online presence, do you have a 4-star rating? Do you have a 4.5? Do you have a 5-star rating? You have to implement and be patient and get people to know you, like you, and trust you, and then they'll do business with you. You cannot just expect everyone to just say, all right, you got my name and phone number, let's do business. It doesn't work like that. 1 to 3% of consumers are ready to buy right now, at least in our business, generally speaking. So what are we doing with the other 97%? We have to show them value. We have to show them that we're authority in the business. The days of calling people out of the blue and taking 20 minutes of their time, they're gone. People want to respond on their own time. And that's why when you get these informations, you need to text message them, you need to email them, you need to show them things of value. So let's take a moment here. I'm going to take you on a journey of some massive value that we give people that contact us. I'm talking tens and thousands of dollars of savings. I'm talking about life-changing things for their kids. I'm talking about extra vacations that they get to take. So let's go in a moment, and I'm going to show you some value-based branding. You would be very surprised at the cost that it costs our customers that we see every day in different credit situations. So I'm going to pass this off to Nick for a second, and we're going to talk about a scenario that we created on an average loan size and what the difference between these two credit scores can cost a customer. Nick, go ahead and kind of run through this illustration for us from a numbers standpoint.
Sure. So like Bryan said, credit is predominantly pretty much everything when it comes to obtaining a mortgage, and it's directly associated with the rate. So based on an average sort of loan size here in our area, what I've done is I've broken down the cost of the difference of having a 660 versus a 740 credit score. And this is based solely only around principal and interest portion. We'll get into other aspects of it later. However, so if you have a 660 credit score versus someone with a 740, the difference in the cost of that monthly mortgage payment is going to be about $155.74 per month. If you calc that out over 12 months, you're looking at $1,868.88 per year. And then further, over 30 years, you're looking at a difference of about $56,000, over $56,000 difference repaid back to the bank versus someone with a 740 credit score.
Wow, guys, can you imagine that number? And this is bad. Like, this is bad for consumers. We're about to turn the page, and Nick's going to explain something that is pretty much as equally as bad that consumers do not understand. It's never even a question that we get asked. And it's really, what is your mortgage insurance payment? Nick, explain to them how this is calculated from a borrower to borrower with these FICO scores?
Sure. Well, first and foremost, we can discuss what mortgage insurance is.
Yeah.
A lot of people think mortgage insurance protects them in the event that they get sick or something like that. And that is absolutely not what mortgage insurance is. Mortgage insurance is placed on a loan anytime you have over an 80% loan to value. So typically we do mortgages that are about 95% loan to value or 90% loan to value, which will have mortgage insurance. Mortgage insurance, just like the rate, is directly related to your credit score, okay? So basically, what mortgage insurance does is it protects the bank in the event that you default. It has absolutely nothing to do with you, per se. So let's say you move into the property, you begin defaulting immediately, then where the mortgage insurance kicks in, it'll pay the bank up to 30% of the loan balance. With that being said, again, it's a monthly cost factor that is linked directly to your credit score. So let's say somebody has a 660 credit score versus a 740 credit score. The cost, the additional cost to have 660 is another $106.08 per month. So if you have 740, you wouldn't be paying that $106. So 660 is $106 more than 740. Over the course of a year, it's another $1,272.96. And mortgage insurance typically falls off at around the 9-year point because that's when you hit the 80% loan to value. So over the course of the 9 years, in this exact scenario, someone with 660 will be paying over $11,456 more than the person with 740 credit.
Yeah, and here's the kicker with this, guys. Not all mortgage insurance is created equal. And what I mean by that is at Fidelis, we've teamed up and pooled our money together, and we have some of the most inexpensive mortgage insurance rates out there. If I'm a consumer, I truly believe you're paid in proportion to the amount of problems you solve in the marketplace you work in. I saved people tens of thousands of dollars based on that seminar. Apply this to your business. Figure out how you can add value to your market, whether it's educating people, saving people money, just doing a great job. Appreciate you guys. Check out the next show. Have a great day.